Is your retirement portfolio filled with companies that look safe but are silently rotting from the inside? What if the most trusted names on Wall Street are actually financial traps designed to look healthy while insiders quietly dump shares? I spent weeks analyzing earnings reports, insider transactions, and SEC filings. What I found will change how you look at your portfolio forever. Across 10 companies spanning retail, telecommunications, pharma, aerospace, and beyond, the warning signs were hiding in plain sight. Let's count them down, starting with number 10. In 10th place, Walgreens Boots Alliance stands as a cautionary tale for anyone who trusted the blue-chip pharmacy brand. Beneath the familiar storefronts and a decades-long dividend streak, the company's foundation has been quietly crumbling. Over the past 5 years, insiders have unloaded nearly $1.2 billion in stock, with the CFO alone selling 1.6 million shares at $46.20 right before a major earnings miss. The share price has collapsed by more than 90% from its all-time high, erasing billions in shareholder wealth. Meanwhile, Walgreens faces $5 billion in near-term debt and has been forced to slash its once reliable dividend. Store closures and mounting competition signal a business in retreat, not renewal. The numbers were hiding in plain sight, but the brand's reputation kept the illusion of safety alive until it was too late. Number 9. AT&T stands as a warning for anyone who believes that a blue-chip label guarantees safety. The company's towering debt load, hovering around $180 billion, is the legacy of years spent chasing mega deals like DirecTV and Warner Media. Instead of delivering growth, these acquisitions left AT&T with a balance sheet stretched to the limit. In 2022, the company slashed its dividend, a 15% cut that shattered decades of steady payouts and left income-focused investors exposed. Just days before a $3 billion goodwill impairment was revealed, the chief executive officer executed a sale of $45 million of stock through a pre-arranged plan. While the branding promised stability, the filings showed a business using financial engineering to mask growing risk. The numbers were there for anyone willing to look past the yield. Intel's story in 8th place is a warning about what happens when a once dominant technology leader loses its edge. For decades, Intel's chips powered the world's computers, and the brand became synonymous with reliability. But the cracks started to show as the company fell years behind in manufacturing technology. While competitors like TSMC advanced to smaller, more efficient nodes, Intel's repeated delays on its own process roadmap left it scrambling. The most public blow came when Apple, a major customer, walked away from Intel's CPUs in favor of its own silicon, stripping billions of dollars from future revenue. Over the past few years, the stock has dropped more than 60% from its peak, underperforming both the S&P 500 and direct rivals. Product launches slipped, key clients defected, and the old motive scale vanished. In a rare twist, insiders have started to buy shares again, signaling some hope from within. But the damage from lost contracts and broken execution is clear. For investors who believe the Intel logo meant safety, the fine print told a different story: one of missed deadlines, eroding market share, and a fortress quietly crumbling from within. Number 7. 3M faces a crisis that goes far beyond manufacturing slowdowns or missed earnings. The company is now defined by a legal time bomb, one that threatens its cash flow, dividend, and even its survival as a blue-chip stalwart. In 2023, 3M agreed to a staggering $10 billion settlement over defective military earplugs, a payout that will drag on the balance sheet for years, but the litigation risk does not end there. The company's exposure to PFAS, known as forever chemicals linked to environmental and health lawsuits, continues to grow, with SEC filings warning of billions more in potential liabilities. The warning signs extend to the executive suite. In late 2025, a senior executive sold $15 million worth of stock, but the mandatory Form 4 disclosure was filed 7 days late, the longest delay in the insider transaction sample. This combination of mounting contingent liabilities and questionable insider timing stands in stark contrast to the company's historic image of safety and reliability. For investors still clinging to the 3M brand, the legal minefield buried in the footnotes tells a far more dangerous story. Number 6. Pfizer offers a lesson in the dangers of mistaking a temporary windfall for lasting strength. After the pandemic, the company's revenue dropped by a staggering 40% as vaccine demand collapsed, erasing tens of billions in annual sales almost overnight. Instead of retrenching, Pfizer doubled down with an acquisition of Seagen worth $43 billion, betting heavily on oncology to fill the gap. But the numbers reveal a more troubling pattern. Free cash flow has turned negative even as reported earnings per share remain positive. This gap signals underlying stress. Cash is leaving the business faster than it is coming in. Insider activity sends mixed signals. In early 2025, director Ronald Blaylock bought nearly 20,000 shares, but other executives have quietly sold into strength. The illusion of safety persists, yet the filings show a company chasing lost profits, not building a durable future. The fine print tells the real story. Extraordinary gains can vanish, and when they do, investors who believe the hype are left holding the risk. Paramount Global is a case study in how legacy media can burn through billions while the world isn't watching. The Paramount name still conjures images of Hollywood glamour, but the numbers buried in quarterly filings tell a far less glamorous story. Paramount Plus, the company's streaming bet, has been losing well over $200 million every quarter, a cash drain that shows no sign of slowing. Instead of generating profits, the streaming division has become a black hole, swallowing capital in a desperate chase for subscriber growth. Meanwhile, the company is weighed down by legacy cable debt, a burden that limits its flexibility and magnifies every operational misstep. Governance offers little comfort. Insiders own less than 5% of the shares, signaling a lack of skin in the game from those making the decisions. While the brand's history projects stability, the financial reality is relentless cash burn, mounting debt, and a leadership team with little personal stake in the outcome. The safe packaging of Paramount Global masks a business model in crisis where the warning signs have been hiding in plain sight for anyone willing to read past the headlines. Number 4. Boeing represents the moment when operational risk collides with investor trust in the harshest way possible. In the span of 2 years, 346 lives were lost in two 737 MAX crashes. An unimaginable human cost sent shockwaves through the aviation industry. But the financial toll has been relentless as well. Boeing has now racked up over $60 billion in cumulative losses tied to safety failures, regulatory fines, and compensation payouts. In 2024, the company was forced to halt production yet again, triggering a $4 billion quarterly loss and raising fresh questions about its ability to recover. Short interest now stands at 14% of the float, reflecting deep skepticism from professional investors, while insiders have sold stock amounting to 0.6% of shares outstanding since the crisis began. The numbers in Boeing's filings reveal a business under siege, where the cost of cutting corners extends far beyond the balance sheet. The brand's legacy once promised safety and reliability, but the filings show a company where risk has become systemic, and shareholders have paid the price. Coming to the top 3, Tupperware Brands is a stark reminder of how nostalgia can blind even seasoned investors to a company's unraveling. For decades, the Tupperware name conjured images of kitchen cabinets and reliable household products, a symbol of enduring American business. Yet behind the familiar branding, the business was quietly slipping toward disaster. In April 2024, Tupperware filed for Chapter 11 bankruptcy, erasing what little shareholder value remained and ending the story for a brand once considered untouchable. The signs were there for anyone willing to look. Insiders sold off nearly $12 million in stock, with trades reported up to 6 days late, well outside the standard SEC window. As the company's core business faltered in the shift to e-commerce, management announced a $600 million share buyback in a last-ditch effort to prop up the stock. The buyback was never completed, and the illusion of value quickly collapsed. Delayed filings and clustered insider sales told a story of insiders heading for the exits while the public clung to the brand's legacy. Tupperware's bankruptcy stands as a warning. No amount of nostalgia can rescue a business that has lost its footing, and the fine print was screaming trouble long before the headlines caught up. Number 2, Macy's is a masterclass in how a seemingly solid foundation can mask years of managerial drift and operational decline. While the brand conjures images of bustling holiday parades and flagship stores, the reality has been a relentless contraction. Since 2016, Macy's has shuttered more than 200 locations, an admission that its retail footprint was crumbling even before the pandemic. Yet beneath the surface, the company's real estate portfolio holds more value than the entire market capitalization, according to estimates from multiple Wall Street analysts. Activist investors have circled repeatedly, arguing that the land and buildings could be worth billions if unlocked or spun off. But instead of decisive action, governance inertia has prevailed. Boardroom battles have flared, proxy fights have come and gone, and still management clings to a shrinking core business. The disconnect is striking: hard assets on the balance sheet, but no credible plan to monetize them for shareholders. While the market waits for a catalyst, the company continues to close stores and lose relevance, illustrating how even asset-rich giants can erode value through indecision. The fine print in Macy's filings reveals not just untapped potential, but a leadership vacuum that has left investors exposed to slow-motion decay. And finally, in first place, Dollar General exposes the myth of the recession-proof retailer. For years, the brand's low-cost promise and relentless store expansion were sold as a shield against economic downturns. But the numbers buried in Securities and Exchange Commission filings tell a different story. Over the past 5 years, insiders have quietly dumped more than $420 million in stock, with 2 major selling waves, one just before a dividend freeze, and another ahead of a $2 billion acquisition that stretched the balance sheet. At the same time, the company was forced to cut earnings guidance twice in a single year, a move that sent shockwaves through the market and revealed just how fragile the core business had become. Shrinkage, meaning inventory loss, hit 1.6% of sales, an ominous signal for a retailer that lives on thin margins. But the most damning figure hides in the cash flow statement. Trailing free cash flow sits at $1.12 billion, while reported earnings per share suggest far more strength, a mismatch that yields a free cash flow to earnings per share ratio of just 0.11. This gap signals that profits on paper are not translating into real cash, a classic red flag for investors. The illusion of safety is shattered by the fine print, insiders heading for the exits, guidance slashed, and operational stress mounting beneath the surface. Dollar General stands as the ultimate warning. Even the most familiar brands can quietly rot from within, and the danger is often hiding in plain sight. Across all 10 companies, one pattern is undeniable. Trusted brands can quietly rot while Wall Street sells the illusion of safety. The warning signs were insider selling, weak cash flow, and mounting debt, and they were always in the filings. In today's market, the packaging looks safe, but the fine print reveals the truth.